Good afternoon, everyone. Welcome to another edition of the Raintree series of client calls. My name is Adam Durgis, for those of you who haven't been on one of these calls before. And I'm joined today by Elroy Gust and Jordan Green of Newlook Capital fame. Really excited to talk about this fund today. And I can tell you that this fund had a pretty big impact on me as an advisor. It was one of the first concepts that I had seen that had some very thoughtful recession-resistant strategies to them. But the concept of the Newlook Industrial Service Fund, for me personally, was a very interesting thing to learn about, because it had never occurred to me to invest or help my clients invest in a concept like this. So I'm certainly not going to steal the thunder of Jordan and Elroy. We'll let them tell the story. But I think in times like these, and as times get more and more uncertain, you're going to see why a concept like this, may make sense to add to your portfolio. So I'm really excited for this call. I'm going to turn my camera off to save some bandwidth and also save you from having to look at all of this. But Jordan and Elroy will probably suggest that you turn your cameras off too until the Q&A starts. And we're going to do everything we can to get this thing done within the hour. So we'll get everybody out of here at the top of the hour. So without further ado, we'll turn it over to the two of you. Thanks, guys.
Thanks. Thank you, Adam, and thanks, Raintree, for having us. We're really excited to talk about the Industrial Services Fund 2 today. Elroy and I talk about it often at Newlook, and we absolutely love the fund, and we're always excited for any opportunity to share that passion with advisors and investors. Before I get into the Industrial Services Fund 2, for anyone who's not as familiar with Newlook, I'll just give you a little background on who we are as a company. Newlook Capital is a private equity firm that currently manages 2 industry specialized funds that are available to both the retail and institutional markets. They is a Dental Services Trust Fund, as well as our Industrial Services Fund 2, which we'll be talking about today. We are a company that has strong family values. We like to pride ourselves in alignment throughout our operating partners, straight through to the investor. And I know Elroy is going to talk about that a bit further. Our head office is based in Burlington, Ontario, and we have about 650 employees platform-wide, with about 18 at the Newlook Capital family office. The reason we're so excited to talk about the Industrial Services Fund 2 is because we found a way to make boring exciting. So essentially the concept of the fund is we buy majority equity in businesses related to fire and gas detection, wastewater treatment, elevator maintenance, or any industry or sector that is regulated by law or managed by law to be regulatory compliant. And we absolutely love these businesses. As much as they might be boring and you don't hear about them often and you don't really see the work that they're doing, to us, boring is a little bit different. At Newlook, we would think of boring businesses as businesses that have predictable, steady cash flow, as Adam mentioned, that have shown recession resilience, and throughout the past 6 months, pandemic resilience as well. They are regulated by some sort of compliance system, so municipality or the fire and gas, like I mentioned before, to be regulatory compliant. And then they have long-term maintenance contracts. We have contracts from 5 to 40 years, which really add to that sticky recurring revenue, which we love at Newlook Capital. I'm going to pass it over to Elroy now to get into a bit of details about the businesses that we own and what we're doing moving forward.
Sure. So really, when Jordan mentioned code compliant, yeah, really we were very intentional in our strategy to the fund and really focusing on code compliant, health and safety related businesses where really there's a component of that revenue that's recurring, and that the recurring nature is enforced by some governing body. For us, that's really important. And especially over the last few months, we've really seen that type of revenue comes back quicker. All of the businesses in the fund were deemed essential services. And what that means is business carried on throughout this time. So for us, that's really important. And one of the things that we always used to point to was a graph we have that actually shows the occupancy rate dropping in downtown Calgary at the same time as our points of service actually increasing over a time period in the same geographic area. It really shows the power of that recurring revenue and that is enforced by some governing body. So for us, that's very important. That service revenue that's driven by code always, we find, has higher margins. It actually has a higher multiple when we go to exit the business, and is the most resilient that we've seen. So, and Jordan had touched on it briefly, a lot of alignment with our operating partners. When we buy a business, we make sure that a good portion of their net worth is still in the business. They're invested to show up every day and to really work with us as partners to make sure that the business is continuing to grow, continuing to develop. And that's really become apparent during these last few months, that having invested management teams on the ground really made the difference that we could see. As you can see, we're very focused on recurring revenue. And again, the recurring revenue portion of these businesses is really where the value is driven. We are even seeing now, and we have this discussion fairly often about what is the value of that recurring revenue that has held up during a pandemic, during a recession that came from that pandemic. And you know, the ongoing discussion we have is, are those businesses actually worth more now because they have shown the resiliency? And I would argue that the multiples that we would expect going forward when we go to exit these businesses that have been successful through this, I think that's going to prove out. Our operating partners actually have done a very good job actually switching from defense, switching to offense, coming out of the pandemic, even now in a stronger position where we're actually growing market share. Our competitors are stumbling. We're actually hiring away key employees to make sure that we're first out of the gate for the work that remains to be done. So for us, that's a very big component of having focused, invested management teams focusing on that recurring revenue. And we have regular management calls. I know Oliver and his team have regular management calls, and it's really focused on that, growing that recurring revenue and how we do that. So just to comment briefly on our acquisition pipeline. So acquisition sourcing and due diligence is a big part of what we do. And the team led by our own Harvard MBA, Oliver, they do a great job of sourcing, screening, due diligence, making sure that the businesses and acquisitions close in a timely and appropriate manner, and then making sure that there is a rigorous reporting mechanism in place, that we're working with those operating partners and those management teams as partners to bring the best out of them that we can. And that's, I think, a skill or a trait that we focus on a lot. It's one of our key values, is making sure that we're not driving our operating partners, but we're helping them get to where we need to go as partners. And one of the things that we focus on here is just getting them to understand that the value of that recurring revenue as we go to exit these businesses or as we grow these businesses. We've had a lot of discussions with our operating partners lately about, hey, look at the landscape of each of your businesses, see who your competitors are, the ones that haven't stumbled, the ones that are still around. Let's have a conversation with them. Is there an acquisition opportunity? Is there something that we could do together with them that would add value? So we're having a lot of those important conversations, and it's proving out. I mean, we have a very robust acquisition pipeline now. I think on the industrial services side, we're close to $48 million in active deals, people that we've engaged with, we're talking to. They're not all going to close for sure, but we have a very good handle on deploying all the capital that we're raising. So they've done a really good job on making sure that we're getting the best businesses available for us to acquire right now. A little bit about the actual businesses in Fund 2. So right now there's 5 businesses, 120 employees, and really love this entry multiple. And I think that will actually come down a little bit the next couple of acquisitions that we do. So 5 times entry multiple. And when I say that, I say that, with hesitation, only that when I'm buying at 5 times. When I'm selling at hopefully 8 times, maybe even 9 times. We'll see if our theory proves out, but we think there's real value to these businesses once they have been acquired by us. We've put in some rigorous accounting and reporting procedures, combining them with other entities in our portfolio, and then exiting at their proper and appropriate multiple. A little bit about the businesses specifically. So we are buying businesses in both Canada and the US. We have 2 fire protection businesses in Ontario, All Protect and Pro Fire. So that's probably where we felt the most impact of COVID. They were declared an essential service. Those inspections, annual fire inspections, still need to happen on a regular basis. But what delayed some of that revenue was the fact that inspections couldn't happen because we couldn't access the facilities. So there was a lot of discussion around that at the time. We're seeing now that there's a significant backlog of inspections and service work that is remaining for us to work through. All of our fire companies in Ontario are actively hiring. We are looking to grow market share. We have a backlog of work that we've brought everybody back to work to dig into, and we're looking for additional help there. So still love the fire business. We were looking to acquire more in Ontario, and I think we're working on a few of those. So love that business. Some of the stats around that we do, last year we did 14,000 annual fire inspections. So lots of recurring revenue. And the other thing about those businesses, we don't have any customer concentration. Our top 5 customers would not be worth more than 10% of the fund's revenue. So lots of mitigation around that risk of customer concentration. The other fire company that we own is Integrated Fire and Security Solutions down in Florida. So they've done a really good job. We've owned that business for over a year now. It's owned by ourselves, and our partners are a father and son team who still own, I think, 35% of the business. Just had a call with them this morning. They've done a great job on continuing to grow during this time. They do a lot of work with school divisions. So we've had a lot of work recently getting schools up and running and ready for back to school this fall. A lot of work around entry systems that are integrated with fire alarm panels. And we're really driving the recurring revenue part of that business. So they have a target to make sure that they're hitting 50% of their overall revenue is recurring. I think right now we're at 44%, I saw this morning. To me, that's a really good outcome. I'd love to be at 50%, but even at 44% of our revenue being recurring, I think for me really shows that we've done what we wanted to do with our operating partners down there. They're ahead year over year by a significant percentage over last year. Looking at a couple of good acquisition opportunities down there. That business is probably one of the larger ones in this fund. I think they're up to 80 employees now, 4 offices down in Florida, and looking again, like I mentioned, to do a couple of acquisitions just in the state of Florida to build out our portfolio down there. So great team to work with down there, and really excellent results this last year. And so far, we really haven't seen a large impact from COVID on that business at all. So it's business as usual for the most part. The other business that we own down in Florida or in the US is Insight Engineering in Alabama. So Insight designs, oversees construction, and then maintains and operates wastewater treatment plants in smaller municipalities in Alabama and Tennessee. So Actually just had a call with them this morning as well. We just did an update call interview with them, Jordan and I, a few weeks ago. So great team down there. The recurring part of the business down there, the words they used this morning was they see no end to the growth. So even just this last week, we had 2 smaller counties call us to take over management of their wastewater treatment programs. That happens now on a regular basis down there. That recurring part of the business is the part that we're focused on. And again, great year-over-year growth, very good results out of there. And we're working on 2 acquisitions, 2 add-on acquisitions for Insight that are going to close imminently, I've been told. We'd love to add that to those businesses down there. That's the business that we brag about a lot, the management team, and the fact that we have 40-year maintenance agreements in some of the wastewater management contracts that we have down there. So love those guys down there. They've been great to work with. And again, they're engaged and invested in the business. I think the management team there's a group of 4 in the management team, and they continue to own 40% of the business. So they're along with us. They're fully aligned with Newlook and our investors. So great group of guys down there. Looking forward to working with them for a long time to come. Bay Elevator is the elevator maintenance business that we own north of Toronto. Just like the other elevator businesses we own in Fund 1, we love that business. We love the fact that it comes with 5 to 7 year maintenance agreements on the elevators that we service. Once we modernize an elevator, it always comes with that add-on maintenance agreement for a period of time. We're continuing to grow our elevator portfolio. We're looking to see if there's maybe an exit possible there, or if there's additional acquisitions. But we love the elevator business overall. Really great group of guys up there at Bay. So we own 70% of the business, and the management team up at Bay owns 30% of the business. So great group of guys. And we'll see what happens with that business in the future. So there's a little bit about the businesses that are in the fund now. And we're really focused right now on just add-on acquisitions.
Thanks, Elroy. Yeah, and just, to reiterate what Elroy said, again, these are businesses. A lot of people, when they think acquisition, they think we're taking over and that we're going to be the experts moving these businesses forward. All of these businesses have a history of generating a positive cash flow. So they're existing excellent businesses, and Newlook is there to add value through our team of CFAs, CPAs, MBA, to add rigor to their reporting, help them with marketing, HR, and just drive the business as far forward as it can go. So really important to remember that these are not businesses that are suffering and looking for an out. These are businesses that have a history of generating a positive cash flow, and Newlook is there to add value to that existing business. So how does this affect you, the investor? So this is just an overview of what you could expect from Newlook Capital. So this is a targeted 8% annual return, which is paid quarterly as return of capital. And at this point, I always like to mention that the fund did launch in June 2018, and Newlook has serviced the distribution since inception. So even throughout the pandemic and the volatility of that situation, we were able to service our Q1 and Q2 distributions at that time. It is a minimum $10,000 investment, and we are looking to raise $100 million. We've raised approximately $36 million to date. A really great fact for anybody who's new to privates or worried about the hold term. This is a 5-year fixed term which started in June 2018. So at this point, investors coming into the fund today are looking at a 3-year term with the possibility of 2 1.5-year extensions. And then I always get the question at the end, why are the 1.5-year extensions there? Why would you use them? And I think the best way to think about the extensions are, imagine that the 5-year term was up at the beginning of COVID. We would have been in a situation where perhaps we were forced to exit at a time which wasn't viable or sustainable, and we would have to take a lower value. So the extensions are there to protect Newlook and to protect the investor and the outcome of that investment. This is a growth and yield strategy. So there is a profit sharing opportunity at exit, and it is 40% to Newlook Capital and 60% to the investor. So, you know, when Elroy was talking about the multiples, like versus when we buy and when we sell, that's really important to see what you guys will be, you know, expecting to receive upon exit. As with all of our funds, this is registered account eligible, so you can use that TFSA, that RRSP, and invest in our industrial services fund too. Just like many issuers and many products in the alternate space, there is limited liquidity. So there is a $50,000 quarterly threshold on redemptions prior to maturity. But we do understand at Newlook that, you know, risk mitigation leads to profitable investing. So, you know, have a talk with your advisor at Raintree. They can go through all of the risk factors and the redemption limitations that you should consider when looking at the Industrial Services Fund too. But this is the second reiteration of the fund. We had the Industrial Services Fund 1, which we learned and grew and developed another fund from. So it's definitely been a lot of consideration from our management team and the partners at Newlook when developing this fund to make sure, you know, that it's as great of an investment as we could possibly make it. We do have a 5% discounted DRIP. So instead of $100 per unit, you're looking at $95 a unit. So you can talk to your advisor about whether a cash distribution or a reinvestment program is right for you. But here you're just showing that, you know, if we reinvest in the product, you're getting a discounted rate, so your money just works for itself. But again, talk to your Raintree advisor and they can go through the DRIP and the power of that DRIP with you and see what's right for you at that time.
Thanks, Jordan. I wanted to comment a little bit about Newlook's tagline, or our slogan, "We are invested." So just an insight into Newlook's culture. When we talk about being we are invested, I think initially it referred to the fact that Newlook's money is actually invested in the fund alongside of investors. So in Fund 2, Newlook Capital has $1 million of our own money invested right alongside of investors in the fund. But I think the term "we are invested" has actually evolved to mean more than that. And we always recognize that it's not only Newlook management, but Newlook's employees now are invested in the success of Newlook and the fund. Newlook is invested in the relationship with our investors. We're aligned with investors. So when we exit these businesses, we all share in the upside. So I think that's, for us, that's very important. We consider ourselves stewards of your capital, and we want to make sure that it's invested wisely and appropriately, and then return to you in that same fashion. So I think we're invested in that relationship with investors. We'd like that relationship to be a long-term investment. And then the other thing that we're invested, the other relationship that we're invested in, is the relationship with our operating partners. Again, I can't stress enough how valuable those relationships have been in a downturn or during the pandemic. It's so important for us to maintain those relationships, to make sure that the businesses perform ongoing. But even more than that is when we're looking to our operating partners for, you know, future acquisitions, future add-on acquisitions, it makes a big difference when those folks are introduced to us by partners and their colleagues in the industry. You know, for us to go to a wastewater management convention and position ourselves as the new private equity player, it just isn't as successful, and it doesn't seem as sincere as when we get introduced to other wastewater management businesses by our partners who are in the industry and know those folks and talk to them on a daily basis. So for us, those relationships with our operating partners are very important. We're very invested in those relationships. And I think that's proven successful for Newlook. It's really shown that those relationships and the amount of effort that we spend on them, it actually proves out in the end to drive value in the businesses. So just a comment on Newlook, our culture, and I think how that attributes to success of the fund and investor success as well. little bit about our management team. I don't know, Jordan, if you were supposed to talk about this slide, but I've worked with the Bass for about 6-7 years now. He's been a great partner. Tony was my first partner, actually. I've been working with him for about 8 years now. Tony is our CFO. He's a CPA, experience at Deloitte and at BDO. Gavin works with Jordan, Allison, and the sales team to make sure that we're educating advisors about our funds, making sure that we have the right mix of investors in the funds. Oliver, like I mentioned, heads up our acquisitions team and now is heavily involved with operations of the fund and overseeing the operation of the businesses. And our most recent partner has been Haas. Haas previously worked as an in-house legal counsel at another private equity firm in Calgary, actually. Came across to us in February and has been invaluable as we have built out this fund, a lot of the legal work around that, and then all the acquisitions. So he's helped us on internal legal and all the acquisitions. A lot of the work that he's done recently has been around employment law during the pandemic, what that looked like for our employees. And now looking forward to the next year on some of the new funds that we're bringing to market. So he's worked with us a lot on that. I feel that we have, listen, I've been partners with a lot of people over the last 25 years in business. And I really feel like right now I have the best partners that I've ever worked with before. And the best team, the best management team, and the best group at Newlook. So we're really excited about the next year, and it's been a pleasure working with these guys even during the pandemic. It's really been great working with them.
Now, Elroy talked a little bit about alignment and what that looks like. And I think one really important point that we might have missed, and it's important to drive home, is how that alignment is secured with the investor. And again, like Elroy mentioned, they have the partners at Newlook have personally invested their own money, and they come behind investors in the capital stack. So Newlook management will not share or cannot share in the exit unless we have serviced our targeted distribution. So it's a great way to know that they're going to work as hard as they can to ensure that this is a sustainable and profitable fund for themselves and for the investor moving forward and at exit. I think Elroy mentioned it a little bit earlier, but we get a lot of the same questions really often. And, you know, right now they're frequently around COVID-19. And Elroy did touch on the essential services aspect of the businesses and how, you know, there was some areas in which perhaps production was decreased during a given time due to a lack of access to the facility. But I like to drive this point home as often as possible is we like to consider this revenue as deferred and not lost revenue. Like Elroy mentioned, we are seeing a backlog as the economies are reopening and we're going back to school, and you know, restaurants and all are going back to business as usual. So that revenue was deferred and we're seeing it come back to us in full now. So it's really exciting to see. I mean, sometimes I like to think my management team at Newlook can predict the future, but unfortunately I know that it wasn't magic. They just developed a really unique fund that did prove, again, to be, as much as we focused on recession resilience, to be pandemic resilient during this unprecedented times. And, you know, having been through it once and knowing now what we do if there was to occur again, we're very prepared, and our operating partners work diligently with our reporting team at Newlook Capital to ensure that we know what we're doing going forward and how we can mitigate the risk if there were to be a secondary spike. Like Elroy mentioned, the code regulation or the code requirement wasn't lifted in any of the municipalities or jurisdictions in which we are involved. And that was really, really exciting for Newlook to watch and work with the operating partners during such a different time and see how well during such a difficult time for so many, our operating partners could perform.
Jordan, there was a little bit of magic there, I think.
I knew you might like that, but I can't, but it's very difficult to, no one knew this was coming, and it's been a really exciting time for Newlook and all of our portfolio companies, and I'm assuming for Raintree as well, to watch how when you have the right group of advisors and the right group of partners, how you could really work together to do something great during a not so wonderful time. Again, Elroy and I are here to ask or answer any questions that you have. We're always available to the advisors at Raintree. So if you like what you've seen today, please talk to your advisor at Raintree. They have full access to Elroy, myself, and the rest of the team of Newlook at any time. And I think we've covered the majority, so I'll pass it back to Adam. I'm sure there's a queue of questions coming our way. Elroy and I love this part the most. So thank you so much for joining us today, for listening to our boring businesses, and hopefully now you can see why Newlook finds boring so appealing.
That's great. Yeah, nobody's ever made boring look so good. You two, way to go. So for those listening on the line, you will notice there's a Q&A box down at the bottom of the page there. So I'd encourage you to ask some questions. I've got a couple of my own here. Jordan, I was really glad earlier in the call you you brought up something about the transition, right? Like when you're buying these companies, it's not a takeover. You're not changing everything, but anybody who works in our industry knows of stories of private equity funds that go in and buy companies, and there can be some particular I guess resistance or nervousness, particularly around blue collar companies, which these would all be blue collar jobs. No blue collar worker wants some suit to come in and tell them how to do their job when they've never done that job. And so I know that this is a very delicate part of the transition. How do you recognize companies that have employees that are going to be, I guess, easier to transition to something like this? And B, have you had any challenges in the past with that?
Yeah, that's a good observation. Good question. I mean, I guess my comment there would be, we really try not to make any major changes on the management team. We spend a lot of time getting to know the management team when we do an acquisition, whether it's, a couple of dinners beforehand, lots of phone calls, lots of interaction. We've walked away from deals that looked great on paper, presented really well. If we don't get a comfort level from the management team and knowing that we're going to be partners going forward, it makes us tough to get engaged on deals. And I think that's, really, if the management team doesn't change, and part of the messaging on day one to the employees at the business is, hey, we had a transaction. It happened in the background. You haven't seen any changes as far as the management team goes. For the most part, those employees are encouraged that over the next couple of months after the initial acquisition, there's positive changes, but there's no change in who they report to, who they're interacting with. All of the change that come is for the most part positive. There's additional working capital put into the business, probably some new vehicles are purchased, things like that, where after this, hey, listen, if their paycheck the first 2 weeks after the acquisition happens didn't change and is there, a lot of people get really comfortable really fast. So.
Right, for sure.
I think we've also seen, like Elroy touched on it a little bit, it's important to remember, Elroy has been talking so much about what we are invested means. So this is a two-way street. We look for companies with like-minded values, for companies, that are family-oriented, that, that want to work with another family-oriented business that cares about their employees, because it shows that we have the same level of care for the people working for us. So I think the post-acquisition oversight, led by the acquisition team, and managing those relationships really helps to minimize any type of J curve. And we've, I've said it before, someone asked us in another video, what's something Newlook should be proud of? And I think the retention of existing employees across both our funds is something that we can be really proud of, because we don't see a high employee loss after acquisition. The retention levels have been quite astounding.
I thought it was interesting this morning when we had our management call with the folks down at IFSS down in Florida. We looked at the year-over-year results, and in fact, EBITDA was double before we did the acquisition. So since we bought it, EBITDA has doubled, and you know the father and son team had joked and said, "Oh, maybe we should have waited a year before we sold." I turned it around and said, "Listen, because you're still an owner, you're actually making just as much money as you did before, and you cashed out." So
Right.
that's a sign of a good partnership. That's a sign of a good partnership.
Yeah, for sure. In terms of your deal pipeline, companies that you're keen on, where are you seeing the most opportunities, and where do you want to be that you haven't quite been able to get yet?
I'd love to own another couple of elevator companies in the U.S.
I knew you were going to say that.
Yeah, I listen. We love that business. We understand that business. We're getting really comfortable with that business. I mean, Tony and I, that was one of the first acquisitions that we did before even Fund One. So if I could have another 2 or 3 elevator companies in select markets in the U.S., I would totally want to do that. Really focused on wastewater management businesses in Canada. We're talking to a few, and in the US, some good add-on businesses down there. But yeah, I mean, that pipeline right now, I want to say it's over 30 businesses at all different levels of engagement. And it's pretty evenly split between the US and Canada. Even though for sure Canada is a smaller market, we seem to have more traction just because it is a smaller market. We're a known entity in Canada. We're still establishing our reputation a little bit in the US. But I thought it was interesting that the M&A investment banking group at Raymond James down in the US actually reached out to us and said, "Hey, we noticed that you guys are focused on the wastewater management treatment business. We have about 6 we want to bring to you." So it's nice to see when we get that kind of recognition from, and I think Raymond James has 350 investment bankers working on mergers and acquisitions in the US. So access to a big pipeline. So.
Yeah, that's great. Do you have the ability to buy a company that doesn't provide code mandated service? Like, can you buy other industrial companies that don't have code compliant service?
I don't know that I'd want to, even if I did have, I don't believe the OM is written that way. I think the documentation leaves us a very tight maneuvering room. We have tons of opportunity even within that mandate. So, and seeing how they've performed, I don't need to go outside of that. I don't really want to. You know, a lot of people, when we first came out with this mandate or this thesis, said, "Oh, why are you putting yourself in a box? It's so specific. Why would you do that?" And I think it gives investors, our operating partners, and the people at Newlook some assurance that this is a very specific business industry line that we're going to get really good at, and that's proven out. So.
Yeah, I like the fact that you are in that little box. You know, the analogy that I always like to use is, you know, if you own an office tower and it doesn't, let's say that tower is 95% full or 95% vacant. As far as the contract to service the elevator, to keep up with your gas detection in the parkade, your fire suppression through the building, it doesn't matter what the occupancy of that building is. You still, according to the code, you have to provide that service, right? Which is why they talk about this being a recession-resistant strategy. But certain things have more resilience to correction and ups and downs than others. And it's a funny pun, but the fact that an elevator company doesn't go up and down as much as other companies, I mean, you can make all the jokes you want. But it's, you know, it's true, right? So you know, there's, if this last year has taught us anything, it's that A, all bets are off, but B, this strategy worked just great. I mean, your performance through COVID has been really quite good. And as you said at the top of the call, Elroy, you know, we won't know for a while here, but but you know, there could be a case where businesses of any kind that did well through COVID could trade at a premium coming out of it, simply because of the fact that I think, you know, most investors are looking at the world going, I don't see any certainty or assurance anytime over the next decade. So something that does well in times like these, you know, maybe I'm willing to pay a little bit more for those assets. So, and again, that still remains to be seen. We don't know that that's the case, but we, you know, we have seen the performance of these companies through, what has it been now, 6 months of COVID? Oh my God, has it been 6 months?
Yeah.
That's a long time. But it, you know, it is nice to see that's done well. Talk a little bit about currency risk. You know, we are talking about a number of American companies here. How do you view the currency risk? Did you explore any way of hedging some of that currency risk? Just talk about that for a minute.
Yeah, I mean, when we do our initial underwriting, we had at the time, and I was waiting for the chart before the call, but I just wanted to see where the US dollar was when we acquired and where it is now, or the Canadian dollar is now. But it hasn't moved enough for us to get worried about it or be concerned about it. What we did do initially is we underwrote based on a 15% discount. So we built in a hedge right out of the gate. Those businesses that we have in the US are now generating enough cash flow that we're actually doing acquisitions from the cash we have on hand down there. We're not sending Canadian dollars to do some of those acquisitions. So that's a natural hedge. Really, when you look at the exit that is a longer, further way out, the cost of hedging at that point becomes prohibitive. But we have looked at hedging strategies around the distribution on a regular basis. We haven't moved ahead with any of that yet because we haven't seen enough movement yet, but we're continuing to monitor it going forward.
Okay, sounds good. That appears to be it for any Q&A, unless there's anybody else that has any questions. Thanks so much for this, not just to you, Elroy and Jordan, who you always do such a good job on these things, but also to the people who chose to invest a little bit of their time with us today to learn about this strategy. I would encourage you, if you have interest in this, I would encourage you to reach out to whoever invited you to the call. And of course, if you need or want more information as a follow-up, ask your Raintree advisor and they'll be happy to get you anything and everything you need. Thanks, everybody. This was a great job and fun as usual. Way to go, you guys. That was awesome.
Thanks, guys.
Okay, take care.